that I had thought there might be more talk about a carbon border adjustment mechanism, or CBAM, between the US and Europe. Europe is proposing such for itself. The US, there's definitely disagreement within the US political space regarding the idea of a carbon tax, but I think it's also increasingly recognized that the only way to drive reduction of emissions to the amount necessary by 2030 is going to require more aggressive carbon pricing. And one of the things I noticed over the weekend was a report suggesting that the total addressable market, or TAM, for global climate adjustment between now and 2030 is $115 trillion. $115 trillion. So, and I don't really, to be honest, I just read the report. I don't have the details of what it actually makes up. But from my point of view, my perspective is that, look, as a global multi-asset investor who has a view that you want to be long equities, long commodities, underweight global government bonds, you want to be in non-US equities, you want to be in value and small caps, etc. I think that asset allocation is pretty well set and unlikely to change in the near term. And that suggests that for me, the opportunity set where I should direct my thinking is in the alpha generation potential within the thematic space. I always like to let the market tell me. Investors should never try and tell the market, right? You have to listen to the collective wisdom. And the market is telling us that EMFX is probably catching a bid, that the dollar was not able to power higher and is now rolling over. And this is where we get into those divergences and what we talked about at the beginning of our session here, that as those divergences collapse and as the bill comes due for American exceptionalism, it's probably going to weigh on the dollar, which will be good for emerging market currency. What would make me bearish? Well, I look at things like liquidity, right? What's the liquidity picture look like? It still looks quite healthy. Plenty of liquidity pumping through the system. What do financial conditions look like? Very, very easy. What do credit spreads look like? Credit tends to give us early warning signals for those of us focused more on the equity side. Credit spreads remain very tight. High yield issuance in the US in April was a record. Default rates for 2021 in the US, high yield default rates are now expected to be only 2%, the lowest in about 5 years. And people talk about these zombie companies that are going to become visible once things reopen. I just don't really, I struggle to understand what that means when you have high yield companies able to access the market without any trouble and extend their maturity mountains. I really don't get the idea of zombie companies at all. And finally, you have earnings, which are extremely robust. So do we really expect to see equities pull back sharply in the face of very strong earnings growth? I don't really think so. And as I wrote, I think now 3 weeks ago, the market has been very, very good at pricking bubbles. You know, the FANG stocks peaked relative to the broad market in September. You had the Robin Hood bros and all that stuff in January, February was a sideshow, as I called it then. You had the ARC names and the thematic names and crypto all get pulled back 20–30%. Bitcoin just had a 25% correction in the last 2 weeks. The idea that we're in a bubble, that there's just crazy sentiment, I don't get that at all. I don't know what people are looking at to make that argument. To me, the market has been very efficient at pricking bubbles. The most recent being the Treasury bubble. The idea that we would have 7% real growth in the economy and have a 1% 10-year Treasury never made any sense to me. But now we've recalibrated. Everybody thinks it's going to be 2% by the end of the year. That's kind of where I've been since November. So but we've kind of repriced that. I think the market has twin engines. It's important to note the value trade and the growth trade. They are trading off. And when rates go up, value works. When rates come down, growth works. And the important thing is that either rates up or down, something is working. And that prevents you from having a significant decline.